Most investors lose money chasing excitement instead of building consistent investing habits patiently. Imagine growing wealth steadily without predicting unpredictable markets or stressful financial headlines constantly. What if investing success depended more on discipline than extraordinary financial intelligence today? Many beginners believe successful investing requires perfect timing and complicated market predictions daily. That belief quietly destroys confidence whenever markets suddenly collapse without obvious warning signs everywhere. Experienced investors understand wealth usually grows through patience, consistency, and emotionally controlled decisions. One surprisingly simple strategy protects investors from dangerous emotional reactions during market volatility periods. That strategy is called dollar cost averaging, and professionals quietly use it for decades. Dollar cost averaging means investing fixed amounts regularly, regardless of market conditions or fear. Instead of waiting perfectly, investors continue purchasing assets during rising and falling market cycles. This strategy removes pressure created by constantly predicting uncertain financial market movements accurately. It transforms investing into a structured habit rather than emotionally exhausting daily gambling behavior. Many wealthy investors quietly follow systems instead of relying completely on personal market instincts. They understand emotions often destroy portfolios faster than actual economic downturns ever could, and fear encourages investors selling low, while excitement encourages buying dangerously overpriced investments repeatedly. Dollar cost averaging creates emotional distance between temporary market noise and long-term financial goals successfully. Imagine investing identical amounts every month despite terrifying headlines dominating financial news channels everywhere. During crashes, your investments automatically purchase more shares because prices become significantly cheaper. During rallies, your investments purchase fewer shares because prices become increasingly expensive gradually. Over time, this process naturally balances your average purchasing costs across market fluctuations efficiently. Many beginners mistakenly believe market crashes always destroy opportunities permanently for ordinary investors completely. Surprisingly, disciplined investors often benefit tremendously from temporary market declines and uncertainty periods. Lower prices allow consistent investors accumulating greater ownership without increasing monthly investment contributions dramatically. That hidden advantage changes how intelligent investors emotionally respond toward market downturns completely afterward. Instead of panic, experienced investors often view declines as future opportunities quietly developing ahead. This perspective separates emotionally reactive investors from disciplined wealth builders, achieving financial independence eventually. Consider two friends beginning investments during unpredictable economic uncertainty affecting global financial markets simultaneously. One friend waits endlessly for perfect opportunities before investing any meaningful amount confidently afterward. The other friend invests fixed amounts consistently, regardless of market fear or excitement levels. Years later, their financial outcomes usually reveal dramatically different results despite similar income levels. Consistent investing often outperforms emotional decision making because markets reward patience over temporary reactions eventually. Dollar cost averaging especially helps beginners uncomfortable risking large amounts during uncertain financial environments initially. Investing smaller regular amounts feels psychologically easier than investing massive lump sums immediately afterward. This emotional comfort increases long-term consistency, which remains critical for successful wealth accumulation. Eventually, many investors fail because they stop investing whenever fear temporarily dominates financial conversations publicly. Consistent contributions continue building portfolios quietly, while emotional investors remain trapped, waiting endlessly outside. The market historically rewards participation more consistently than perfect timing strategies over decades globally. Even professional investors struggle accurately predicting short-term market movements consistently every single year successfully. Yet ordinary investors still believe perfect timing guarantees financial success without significant long-term risks. Dollar cost averaging removes dangerous expectations surrounding impossible market prediction abilities completely for investors. It encourages focusing attention toward controllable habits instead of unpredictable external financial circumstances daily. This man, Sarah, watched financial news daily, constantly waiting for perfect investing opportunities appearing confidently everywhere. Every market decline convinced her massive crashes would continue destroying investments permanently afterward everywhere. She delayed investing repeatedly, believing patience guaranteed safer and smarter future financial decisions eventually. Meanwhile, her co worker Daniel followed simple dollar cost averaging strategies without emotional hesitation, consistently monthly. Daniel invested identical amounts every month, regardless of economic uncertainty or frightening headlines everywhere. Some months markets climbed rapidly, while other months markets collapsed unexpectedly without warning signs. Daniel ignored temporary noise because his strategy depended entirely on disciplined, consistent investing behavior. Sarah continued waiting nervously, convinced perfect timing would eventually maximize future financial returns dramatically. Years later, Daniel accumulated significant portfolio growth while Sarah still feared investing mistakes deeply. Their different outcomes revealed powerful lessons about consistency, emotions, and long-term investing psychology clearly. Many investors unknowingly sabotage themselves while avoiding temporary market discomfort or uncertainty repeatedly. Human psychology naturally fears losses more intensely than appreciating potential future financial gains emotionally. That emotional imbalance encourages hesitation whenever investment opportunities appear during uncertain economic conditions globally. Dollar cost averaging works effectively because it bypasses emotional reactions, influencing dangerous financial decisions frequently. Instead of relying emotionally, investors follow predetermined routines, supporting consistent long-term portfolio growth naturally. This disciplined approach reduces stress caused by constantly monitoring unpredictable market price fluctuations obsessively. Imagine investing calmly while others panic whenever sudden economic headlines dominate conversations internationally afterward. That emotional stability often becomes stronger than advanced financial knowledge or complicated investment strategies. Wealthy investors frequently emphasize controlling emotions instead of predicting impossible market movements accurately beforehand. They understand markets naturally rise and fall unpredictably throughout every historical economic period. Consistently, temporary declines feel painful emotionally, yet historically markets recovered stronger after major downturns repeatedly. Investors' continuing contributions during crashes often benefit tremendously once markets eventually rebound strongly afterward. This hidden advantage explains why disciplined investors sometimes welcome temporary price declines calmly instead. Lower prices allow consistent contributions, purchasing greater ownership without increasing monthly investment amounts dramatically. Imagine buying valuable products cheaper while everyone else irrationally avoids purchasing opportunities completely afterward. Smart investors recognize market declines, creating discounts instead of permanent financial disasters emotionally afterward. Dollar cost averaging trains investors viewing volatility differently from emotionally reactive market participants completely over time. This mindset shift transforms fear into patience while encouraging disciplined long-term investing habits naturally afterward. Consider investors beginning contributions during terrifying economic recessions affecting global confidence levels severely everywhere. Many people stop investing entirely because fear convinces them recovery becomes permanently impossible afterward emotionally. Yet history repeatedly demonstrates markets eventually recovering despite devastating financial uncertainty and panic periods. Investors maintaining consistency during difficult periods often experience impressive future portfolio growth afterward naturally. Dollar cost averaging keeps investors participating during uncertain moments when opportunities quietly develop beneath fear. Missing those moments sometimes damages long-term growth more severely than temporary investment losses themselves afterward. Many successful portfolios grow because investors remain consistent during emotionally uncomfortable economic environments patiently. Consistency matters because compounding requires time, patience, and uninterrupted financial participation throughout decades successfully. Every skipped contribution potentially reduces future growth opportunities created through long-term compounding effects significantly. Small regular investments may appear insignificant initially, but gradually create impressive financial momentum eventually afterward. This process resembles planting. Most investors secretly fear market crashes because losses feel emotionally devastating and deeply personal. Financial headlines amplify panic, convincing ordinary investors catastrophic collapses destroy futures permanently afterward everywhere. Yet surprisingly, market crashes often create extraordinary opportunities for disciplined long-term investors quietly afterward. This perspective completely changes how intelligent investors emotionally respond to falling market prices consistently. Imagine entering your favorite store and discovering valuable products suddenly discounted dramatically overnight unexpectedly. Most people would immediately recognize opportunities instead of avoiding purchases during massive sales events. Strangely, investors react opposite whenever markets offer investments cheaper during economic uncertainty periods globally. Fear convinces them lower prices represent danger instead of hitting long-term financial opportunities developing quietly. Dollar cost averaging reverses this emotional thinking through structured, consistent investing habits automatically over time. Instead of panicking, disciplined investors continue purchasing investments during frightening market downturns calmly afterward. Their fixed contributions automatically buy more shares whenever prices decline significantly during uncertainty periods. This invisible advantage quietly strengthens portfolios, while emotional investors abandon markets completely afterward prematurely. Many fortunes historically grew because investors remained disciplined during terrifying financial crises patiently afterward. Consider global recessions where fear dominated headlines and uncertainty overwhelmed ordinary market participants completely. Millions stopped investing entirely because economic conditions appeared hopeless and permanently damaged emotionally afterward. Yet disciplined investors continuing contributions often experienced extraordinary portfolio growth during eventual recoveries afterward. Naturally, markets historically rewarded patience, while emotionally reactive investors repeatedly missed powerful rebound opportunities afterward. This hidden pattern appears repeatedly throughout financial history despite changing economies and global uncertainties constantly. Emotional investors usually buy investments after prices rise and confidence returns publicly afterward everywhere significantly. Unfortunately, they often purchase overpriced assets because excitement replaces rational long-term financial thinking completely. Dollar cost averaging prevents this dangerous cycle by removing emotional timing decisions from investing habits entirely. Investors contribute consistently, whether markets appear optimistic, uncertain, or completely terrifying emotionally afterward globally. This consistency matters because nobody accurately predicts exact market bottoms or future recoveries consistently ever. Even professional experts regularly fail forecasting short-term market movements despite advanced analytical experience repeatedly afterward. Yet ordinary investors still believe waiting perfectly guarantees greater investment success and financial safety eventually. That belief often delays participation, while disciplined investors quietly accumulate long-term financial growth consistently afterward. Imagine standing outside opportunities forever because uncertainty prevents taking meaningful financial action courageously afterward. Many people unknowingly remain trapped there, endlessly waiting for impossible certainty before investing confidently, consistently. Dollar cost averaging teaches investors embracing uncertainty instead of fearing unpredictable financial market fluctuations emotionally afterward. This mindset shift creates emotional resilience, supporting stronger long-term financial decision-making consistently afterward naturally. Successful investing rarely depends entirely on intelligence, predictions, or complicated financial strategies alone consistently. More often, success depends controlling emotions during periods of uncertainty, panic, and overwhelming fear. Investors remaining calm during market declines usually gain advantages unavailable to emotionally reactive participants afterward. Emotional reactions encourage selling low, while disciplined systems encourage consistent long-term wealth accumulation naturally afterward. This difference appears small initially, but dramatically changes financial outcomes throughout future decades significantly afterward. Imagine two investors facing identical market crashes affecting portfolios and personal confidence simultaneously everywhere globally. One panics immediately, selling investments before losses increase further during economic uncertainty periods afterward. Starting dollar cost averaging feels surprisingly simple once complicated. Investing fears disappear completely afterward naturally. Many beginners assume investing requires massive savings before meaningful financial growth becomes possible eventually afterward. In reality, consistent smaller contributions often create powerful long-term portfolio growth over decades gradually. The first step involves choosing investments supporting long-term financial goals and personal risk tolerance. Many investors begin with diversified index funds because they reduce unnecessary concentration risk effectively afterward. Diversification spreads investments across multiple companies, reducing damage from individual business failures significantly afterward. This creates stronger portfolio stability during unpredictable economic conditions and volatile market periods globally afterward. After selecting investments investments, investors decide fixed contribution amounts, matching comfortable monthly financial budgets. Realistically, the amount matters less initially because consistency remains more important than occasional larger investments afterward. Even modest contributions grow meaningfully whenever disciplined habits continue consistently throughout future decades patiently. Beginners often underestimate small contributions because immediate results appear insignificant and financially unexciting initially afterward. Yet compounding transforms consistent investments into increasingly powerful financial growth engines gradually afterward, naturally. Imagine planting tiny seeds today, eventually producing enormous trees through patience and consistent nurturing afterward. Investing works similarly because time quietly multiplies disciplined efforts into meaningful future financial freedom gradually. The next step involves choosing regular investing schedules, supporting long-term consistency comfortably afterward, naturally monthly. Many investors prefer automatic monthly contributions because automation removes emotional decision-making entirely afterward successfully. Automated investing ensures contributions continue regardless of temporary market fear or personal uncertainty periods afterward. This system strengthens discipline because habits continue functioning without relying completely on motivation consistently afterward. Motivation changes frequently whenever markets fluctuate dramatically or frightening economic headlines appear publicly everywhere afterward. Automated routines protect investors from emotional reactions, damaging long-term financial progress repeatedly afterward globally. Imagine building wealth quietly while focusing attention toward careers, families, and personal responsibilities peacefully afterward. Dollar cost averaging allows this simplicity because structured systems handle investing consistently without constant monitoring afterward. Many successful investors intentionally simplify financial routines instead of creating unnecessarily complicated strategies repeatedly afterward. Complexity often encourages confusion, hesitation, and emotionally inconsistent investment decisions. Eventually afterward, naturally for beginners, simplicity encourages consistency, which remains essential for sustainable long-term portfolio growth throughout decades successfully afterward. Another important step involves maintaining realistic expectations regarding market performance and temporary investment fluctuations consistently. Markets naturally experience declines, uncertainty, and volatility throughout every historical economic period, repeatedly afterward globally. Beginners sometimes panic because they incorrectly assume temporary losses indicate permanent investing failures emotionally afterward. Dollar cost averaging works effectively precisely because markets fluctuate unpredictably over time, naturally afterward consistently. Lower prices during declines allow fixed contributions, purchasing greater ownership without increasing investment amounts afterward. Understanding this principle helps investors remain calm whenever temporary uncertainty dominates financial conversations publicly afterward. Emotional control becomes easier whenever investors understand volatility, supporting future opportunities quietly afterward. Naturally, instead, successful investing depends less upon avoiding uncertainty and more upon responding wisely during difficult periods. Many beginners fail because emotional reactions interrupt consistency whenever markets become temporarily uncomfortable afterward emotionally. Discipline matters because interrupted investing habits weaken compounding effects, supporting long-term financial growth significantly afterward. Imagine stopping exercise routines repeatedly whenever progress temporarily slows or motivation disappears unexpectedly afterward completely. Most people believe wealth belongs exclusively to experts, geniuses, or naturally gifted investors permanently afterward. Yet financial success often begins through ordinary habits repeated consistently despite uncertainty and fear afterward. Dollar cost averaging proves disciplined behavior frequently matters more than extraordinary financial intelligence consistently afterward. This realization changes investing from intimidating complexity into manageable long-term financial progress gradually afterward naturally. Imagine transforming small monthly contributions into life-changing opportunities through patience and disciplined consistency afterward. That transformation rarely happens dramatically because compounding works quietly beneath everyday financial decisions afterward consistently. Many people miss this truth because modern culture celebrates immediate success and overnight achievements constantly. Real wealth usually develops slowly before suddenly appearing impressive after years of disciplined patience afterward. Investors abandoning consistency prematurely often miss extraordinary growth, developing quietly beneath temporary uncertainty afterward. Naturally, dollar cost averaging protects against this mistake by encouraging uninterrupted long-term investing habits consistently afterward successfully. Consistent participation matters because markets historically rewarded patience despite unpredictable economic challenges repeatedly afterward globally. Every recession, crisis, and market collapse eventually tested investors emotionally before recoveries appeared afterward. Naturally, disciplined investors survived because structured habits replaced emotional reactions during uncertainty periods afterward consistently. Emotional investors frequently sold investments prematurely, locking losses before markets eventually recovered strongly afterward. This cycle repeats constantly because fear influences human decisions more powerfully than logic emotionally afterward. Dollar cost averaging interrupts the dangerous cycle through automated, consistent investing, regardless of market conditions afterward. Investors continue building ownership steadily, while emotional participants remain trapped, fearing temporary uncertainty afterward globally. Over decades, this difference creates dramatically different financial outcomes between disciplined and reactive investors afterward. Imagine future opportunities created because consistent habits quietly strengthen your portfolio every single month afterward. Financial freedom often depends less upon income and more upon disciplined long-term financial behavior consistently afterward. Many ordinary earners eventually achieve independence because consistent investing quietly compounds throughout decades afterward naturally. Meanwhile, higher earners sometimes struggle financially because emotional decisions repeatedly interrupt long-term progress afterward significantly. This truth surprises many people, believing wealth depends entirely upon salary, luck, or timing afterward exclusively. In reality, disciplined systems frequently outperform emotional decision-making within unpredictable financial environments afterward consistently. Dollar cost averaging simplifies investing enough for ordinary individuals, balancing demanding responsibilities and uncertain schedules afterward. People no longer require constant market monitoring or impossible prediction abilities for meaningful financial growth afterward. They simply need structured consistency, supporting disciplined participation throughout future decades patiently afterward. Naturally, this accessibility makes investing less intimidating for beginners uncertain about complicated financial terminology afterward. Initially, many investors delay starting because they fear making irreversible mistakes with limited financial knowledge afterward. Dollar cost averaging reduces this pressure because investors gradually build experience while contributing consistently afterward naturally. Learning happens progressively instead of requiring perfect expertise before beginning meaningful investing journeys afterward successfully. Confidence grows naturally whenever investors witness disciplined habits producing measurable long-term progress afterward consistently. Eventually, investing stops feeling terrifying and starts feeling empowering, intentional, and financially liberating afterward naturally. This emotional transformation often matters more than temporary portfolio fluctuations or unpredictable market headlines afterward. Investors mastering emotions usually remain consistent, while others repeatedly abandon opportunities during uncertainty emotionally afterward. Emotional resilience becomes powerful because financial markets constantly test patience through volatility and unexpected challenges.